for it because the numbers they gave him were really enticing, but again, he went through and he acted like a horse handicapper. Now here's another point of departure from what almost anybody else would do. Everybody that I know or knew as an analyst would have created a model for this company and would have projected out its earnings and would have looked at its return on investment and da-da-da in the future. Warren didn't do that. In fact, in going through hundreds of his files, I've never seen anything that resembled a model. What he did is he did what you would do with a horse. He figured out the one or two factors that could make the horse succeed or fail, and in this case it was sales growth and making the cost advantage continue to work. And then he took all the historical data, quarter by quarter, for every single plant. He got the similar information as best he could from every competitor they had, and he filled pages with little hint scratches of all this information, and he studied that information. And then he made a yes-no decision. He looked at it. They were getting 36% margins. They were growing over 70% a year on $1 million of sales. So those were the historic numbers. He looked at them in great detail, just like a horse handicapper studying the tip sheet. And then he said to himself, I want a 15% return on $2 million of sales. And then he said, yeah, I can get that. And he came in as an investor. Okay, so what he did is he incorporated his whole earnings model and compounding discounted cash flow into that one sentence. I want 15% on $2 million of sales. Why 15%? Because Warren is not greedy. He always wants a mere 15% day one return on investment, and then it compounds from there. That's what all he's ever wanted. He's happy with that. You're not laughing. What's wrong? And it's a very simple thing. There's nothing fancy about it, and I think that that's another important lesson because he's a very simple guy. He doesn't do any kind of discounted cash flow models or anything like that. For decades, he just says, I want a 15% day one return on my investment, and I want it to grow from there. Ta-da! And the $2 million of sales was pretty simple too. It had $1 million, it was growing 70%. There was a big margin of safety built into these numbers. It had a 36% profit margin. He said, I'll take half that. And he ended up putting $60,000. I'm thinking in more modern terms. He ended up putting $60,000 of his personal non-partnership money into this company, which was about 20% of his net worth at the time. He got 16% of the company's stock plus some subordinated notes. And the way he thought about it was really simple. It was a one-step decision. He looked at historical data, and then he had this generic return that he wants on everything. It was a very easy decision for him. And he relied totally on historical figures with no projections. I think that that's a really interesting way to look at it because I saw him do it over and over in different investments. So what happened? Well, the company changed its name to Data Documents. He owned the investment for 18 years. He ended up putting another $1 million into it over time. It was bought out by Dictograph in 1979, and he earned a 33% compounded return over the 18 years that he owned the investment. So it was not too bad. And that was typical. I gave you this example in part because it was the other time besides Geico that he got a Phil Fisher type growth company at a Ben Graham-like price. It was the most vivid example of that I found. But it was a private investment, and there's not a lot of public information about it available. So fast forwarding a little bit, why he thinks so much about catastrophe. Firestone's law of forecasting is always on his mind. Firestone said that Chicken Little only had to be right once. And that's always the first thing that Warren thinks about. And so why is Berkshire Hathaway today not dealing with some of the problems that other people are? It's because Warren passed on investing in a lot of things that he could have, because the first question he always asks himself is, what's the cat risk? And if the business or investment has cat risk, then he just says no. And we could probably get into an interesting discussion about some things like AIG. That was a stock that I was wrong on for a long time until I finally turned around. But he never invested in AIG because of the cat risk. People brought in Bear Stearns and Lehman, and he never invested in them because of the cat risk. And he saves himself a lot of time and energy this way. Because if you ask yourself the cat risk question first, then you don't have to do any of the other work, all those pages of numbers, historical data. So because Warren is basically focused on efficiency, that's why he does that. And he's also very good at being realistic. And once he figures out that something does have the cat risk, he never, ever kids himself and tries to talk himself out of changing a decision. So today, when you think about what's happening right now with deals like GE and Goldman Sachs, people are still bringing him special deals that nobody else can get. He's still making sure they don't have the cat risk as best he can. He's making a bet there on the management, but also his own reputation as an investor, to some extent, can cat-proof these deals. And they're giving him a 10% guaranteed return. And that's the minimum, but he's going to get his 15%. He still wants the 15%. At times, he's taken less and lowered his standards, and he's usually been sorry when he has. And when it comes to the market as a whole, he uses somewhat the same technique. He recently said that he finds the stock market attractive now. In his 1999 Sun Valley speech, he talked about investing in the market when the stock market's value was between 70 and 80% of GDP. It's somewhat the same method because at that level, obviously the whole stock market's not going to go to zero. He's got a huge margin of safety built into that, just as the 15% return and the $2 million included a huge margin of safety versus how fast Mid-Continent Tab Card Company was actually growing and the margins that it was actually getting. And so he's put his margin of safety into the return expectations, and he's using only historical data. He's gone back and he's used years and years and years of data to arrive at the conclusion that, again, probabilities, he's handicapping that it's the right price to buy. And he doesn't really care if it goes up or down for the next year or two. He just knows that at this price, the odds are that it will do well. I do think it's really amazing that right now, 3 weeks later, there are pundits out there who are saying that the greatest living investor of our time and possibly ever is wrong for having made these investments and having predicted that the stock market is a buy right now. It is really ironic and interesting that somebody who, as far as I know, has never been wrong in making a prediction, the people who make wrong predictions every day and have been in the past wrong in saying he's wrong are out there once again saying that he's wrong. And also, I think it's worth mentioning, because we're talking about this handicapping concept, something else. This is just a little quote from The Intelligent Investor, which is that the margin of safety is always dependent on the price paid. If, as we suggest, the average market level of most growth stocks is too high to provide a margin of safety for the buyer, then a simple technique of diversified buying in this field may not work out satisfactorily. And that obviously applies to the market as a whole. And one thing I think that Warren Buffett should get a huge amount of credit for and a round of applause for is never, ever having advocated dollar cost averaging, because it's wrong. It's led many people off a cliff. It's not right to buy the market at any price. And you've never heard him suggest that anybody should do it. And I think he should get a lot of credit for that. So in the end, I'd like to just say thank you for listening to this story, and I hope it gives you a little bit of insight into how he thinks, but it's also indefinable. There's certain things about him that are a mystery and will never be explainable, and there's one thing about him that you can emulate, but only if it comes from the right place inside you. It's been said, and this came early to Warren, that the only person really qualified to advise you as to what you can do is yourself. And he calls this his inner scorecard. You know yourself better than anyone else does. You and you alone know how determined you are to make a success of any undertaking. And in the last analysis, about 90% of being successful in business is that indefinable thing, which, for a lack of a better name, we call guts. And that is from the book, 1,000 Ways to Make $1,000. Thank you, and I'd be very happy to take any questions now.
Thank you, Alice. Let's have our first question.
Hi, I'm Josh Langsam. I'm a first-year student from Darden. Your book has been extremely well received. Do you have plans for future work? And if so, what subject might you look to cover and why?
Okay, I do. I'm sure that I'll write another book. I don't expect to write another biography similar to this one because a subject worthy of following this one, I can't think of who it would be. I have enough material to write a very interesting investment book, and I would be very likely to be writing about some of what I talked about tonight, but I've thought about some other ideas, and it's best to just kind of keep them here. Okay, yes?
Hey, Allison, thank you for the insights on the book. One of the things I thought was interesting is, given your background as an insurance analyst and his experience with Geico, when he stepped in the early 70s, it was considered, and thinking you mentioned in the book, he said to somebody, I might have put money to work where I could lose all of it. But also, if I remember correctly, you talked about how he said to Solomon, he said to Gutfred, you know what, I'll backstop this. So although that sounds contradictory, it also sounds like maybe he was gaming it because he could recapitalize it if they still had a durable competitive advantage, even net of their gross liabilities. Is that the right interpretation, or did I miss something?
I think there was a similarity between the two situations in that in both cases he knew that his reputation was the backstop. You know, he said, I put something into a situation where I could lose all my money tomorrow, but honestly, the margin of safety was himself. And with Solomon, I don't think he knew he'd have to call upon it, but basically he was selling his reputation to them, and that's why he got the high price. And in the end, he actually had to reach in and pull that reputation out and use it, something that was very painful for him. I don't think he ever thought he would have to do it, but I think that's what the situations actually have in common. He was the margin of safety.
Okay, thanks.
Okay. Anybody else?
I have one more, I guess. A lot of